Alright guys, so the US-China trade war is evolving fast. A lot of things are happening behind the scenes. Trump recently went on many interviews and made many statements. And at the core of the problem is a deep misunderstanding of how tariffs actually work. Without a doubt, Trump still believes prices in the US won't rise. In fact, he says that China will eat the 145% tariff the US imposes.
Secretary said we basically have an embargo on China.
Look, you're trying to say something's going to happen, Terry.
No, okay, well,
nothing's going to happen.
You know business.
Terry,
I want to ask you.
Terry, I do know business.
Yes,
and
so 145% tariffs on China, and that is
that's good.
basically
that's
an
good.
embargo.
They deserve it.
It'll raise prices on everything from electronics to clothing to building houses.
You don't know that. You don't know whether or not China's going to eat it.
That's mathematics.
China probably will eat those tariffs, but at 145, they basically can't do much business with the United States. And they were making from us $1 trillion a year. They were ripping us off like nobody's ever ripped us off. And by the way, we have other countries that were just as bad. If you look at the European Union, it was terrible what they've done to us. Every country, almost every country in the world was ripping us off. But they're not doing that anymore.
I want you to think.
But let's get serious here. He really believes that Chinese exporters will eat a $145 import tax on a $100 sale. No business on earth will ever consider that. All that does is grind US-China trade to a screeching halt. So prices will head up for consumers, but the end result will be deflationary for the US economy. And there's a third option that Washington refuses to admit, that Americans simply won't spend their money. We are already halfway towards a recession. US GDP has collapsed in Q1, and that's even before the global 10% tariff. Now, in a survey, market participants believe that the Trump administration will crack. Almost 50% believe the damage will begin in the second half of May, and by June, there will be massive pain. And just like how the bond market forced Trump to U-turn, this time it could be US stocks collapsing. 68% say US retail stocks are the most vulnerable, and if things go wrong, the crash here would be epic. Remember how financialized the US economy is. People's wealth is connected to US equities. Over 60% of households, they hold stock in US companies. So when sales in Walmart collapses, so does their stock price. And this creates a flywheel effect where people feel poorer, so they spend less, and that in turn crashes the stock even more. We must not underestimate how bad the situation can get. The supply chain shock could get much worse until Trump decides to U-turn the tariffs. Affordable imports from China are collapsing because no one in the right mind will pay the 145% tariff. US importers are broke and Chinese exporters definitely won't play ball. The Port of Long Beach is seeing a big surge in cancelled inbound cargo in Q2, the April to June quarter. We have gone from 8 cancellations to 34. That's a 300% increase from the year before. This is the very definition of a supply shock. The threat of empty shelves is about to get very real, and prices across the board, they are only going to rise. And if you think about it, the White House is pitting the US consumer against China's export economy, and who will crack first? Here's the scary part, Trump is downplaying the supply shock to a big degree even today. That's even after the US economy contracted by 0.3% this quarter.
And I told you before, they're having tremendous difficulty because their factories are not doing business. They made $1 trillion with Biden, $1 trillion, even $1.1 trillion with Biden selling us stuff. Much of it we don't need. You know, somebody said, oh, the shelves are going to be open. Well, maybe the children will have $2 instead of $30, you know? And maybe the $2 will cost a couple of bucks more than they would normally. But we're not talking about something that we have to go out of our way. They have ships that are loaded up with stuff, much of which, not all of it, but much of which we don't need.
You now have less choices and fewer products, but prices will be heading up. How is that a win for anyone? And it seems that Washington is starting to crack. Now, we have heard the same old refrain, that the US won't crack and China will bow down first. But new reports are surfacing that this might not actually be true. Now, China is saying that the US has reached out to initiate tariff talks, and this is from the Chinese state media, and if it checks out, then the US is trying to look for an off-ramp. But pay attention to this statement. China doesn't need to talk to the US until it takes meaningful measures. So the message is loud and clear. If the US doesn't reduce or remove the tariffs first, Beijing is not going to talk. This is horrific because it puts even more pressure on the US to act first. Now, Trump was quick to defend the GDP collapse and pointed to core GDP, that US internal growth has increased by 3% and investments are up by 22%. Sounds very impressive on the surface, but if we look closely at the GDP breakdown, we can see something rather disturbing. The US consumer is starting to break down. That's the bread and butter of the economy. Firstly, personal consumption grew at only 1.3%. That is the smallest increase since the second quarter in 2023. Investments contributed to 3.8% to growth. But look closer at exports and imports. Even before April, US export growth was stagnant. International demand for US goods isn't really growing. Meanwhile, US consumers rushed to front run the tariffs by buying a ton of imports, and that dragged GDP down by almost 5%, turning the entire figure negative. Now that global tariffs have been imposed and the tax to China is now 145%, consumer spending is on the brink of collapse. We also know government spending is not going to increase, so the only saving grace left is US investment. And will more companies start spending more and continue building new factories in the US? Because if they don't, Q2 figures will be even deeper in the red. And unlike Washington, US companies and global companies everywhere, they are rational, they are concerned about future profits, and whatever stuff made in the US will be exclusively for the American consumer. Manufacturing costs will be so high that trying to export products out will be quite impossible. And with government spending falling, everything will fall on the backs of the consumer once again. Even McDonald's is sounding the alarm bells. Fast food prices are getting out of reach, and that's saying something. Same-store sales have crashed by 3.6% in the US in Q1 this year. That's the biggest drop since the pandemic in 2020. Fewer people are heading to McDonald's because prices are just too high. So the company is going to extend their $5 value meals to draw in the crowds. But how long can that last? That's going to burn their balance sheet down. Even in food, US tariffs are going to raise prices. Now you cut away affordable imports, while domestic farming costs also increase. The end result? Food inflation everywhere gets worse. Even Bessent is getting desperate for a China deal. He's now moving to dial back the demands, and this time the US might have an even smaller ask from China. Now, Bessent admits that the US wants to revisit Trump's Phase 1 trade deal with China. Well, I guess if you want an off-ramp while scoring a win that China won't fulfill, this might just be it. He knows the brutal tariffs on Chinese imports will just crush the US economy even further. There's no way to magically create US supply chains or to conjure consumer products from thin air. But if we look at previous Phase 1 commitments, it's obvious who will be the big winner here. Trump will call this a victory, but it probably won't be. In the deal, China was supposed to purchase an additional $200 billion in US goods over a 2-year period, basically to give the United States more business to help their industries. And this included $77 billion in manufactured goods, $52 billion in energy, $32 billion in farm products, and $38 billion in services. It's part of the plan to reduce the trade deficit with Beijing so that Trump can call it a victory. But China doesn't need and probably doesn't want to fulfill it. By the end of 2021, they met less than 60% of the purchase targets, and this time China's supply chains are even more diversified. They are buying energy from Russia, food from Brazil, and Chinese factories are supplying cheaper and even better products to the domestic market. So asking China to swap diversification for US dependency isn't going to fly anymore. There's a very good chance that China could even reject this deal because there's no guarantee that the tariffs will come down forever. And by buying US goods, Beijing will reintroduce a dependency risk which they obviously don't want. And on the surface, everything looks fine and dandy in the US. During the latest press conference, Bessent told the world that everything is going on as planned.
Since January 20th, interest rates, mortgage rates are down, gasoline and energy prices are down. We're expecting the further decreases. And as Caroline said, the big tax on consumers that goes unnoticed is deregulation. or regulation, and we are deregulating and bringing that down. So, from a household income point of view, we would expect real purchasing increases.
But that's not the case. The situation in Washington is getting desperate. Now, we have mentioned before how the real economy is tied to US financial markets. By tinkering with trade policy, Bessent blew up the bond market, and now he wants to tinker with the Treasury market to save the economy. And according to the billionaire, the Federal Reserve should start cutting rates immediately. The 2-year yield, which is around 3.6%, is below Fed funds rate, which is around 4.5%. Now, I have no idea where this signal came from. He probably pulled it out of hat. But it does show how desperate the entire situation is. Bessent wants borrowing costs to fall to boost spending and investment. But there's a reason why the Fed isn't cutting, because trade policy is still very uncertain. Countries themselves could ramp up their own retaliation. Consumers are also facing higher prices. Rate cuts could reignite inflation. Basically, the Fed wants to crush demand even further, and to be frank, it could really go either way at this point. However, Bessent is willing to risk higher inflation because he believes the risk of total collapse is bigger, and at least on this point, Bessent might just be right. And if prices go up high enough, demand will collapse, and that could crash the bond market again as capital leaves the US market. So Bessent is trapped and forced to bring back a very desperate program. The US Treasury has signaled changes to their bond buyback scheme. They have already problems trying to sell long-term treasuries because demand just isn't strong enough. And to make sure liquidity doesn't freeze up, they would start to increase the level of treasury buybacks. Currently, the Treasury buys back $4 billion per quarter worth of 10 to 30 year debt, but this could increase by 50% in the future to goose up the market. Now, this sounds like a smart liquidity tool, but it sends a lot of mixed signals to the market. Is this a type of QE to swipe a credit card to kick the can down the road? And why focus on long dated treasuries? Is Bessent admitting there's falling demand for long term US debt? Just misinterpretation alone can spike yields even higher. But there's also two additional risks of treasury buybacks we must highlight. Bessent is betting on interest rates or bond yields dropping. But what if they don't? If rates rise, the US Treasury could be sitting on a loss instead of a gain, and this will be accounted for by increasing the deficit if the shortfall is big enough. That is the first risk. The second problem is funding risk. To fund the buybacks, Bessent will have to issue new debt, and this would most definitely be short-term T-bills. But if he borrows enough, this could raise yields even on the short end. The market will see this as a gimmick and quickly deduce the entire treasury market is in trouble, and that pushes short-term yields up higher as well. And should this go on long enough, the national debt will blow up further. Interest payments would also head up. So treasury buybacks aren't a magic solution. Done wrongly, it could undermine the entire bond market. And that's why investors are betting on how this trade war will end. If the US market sell off aggressively enough, the only solution left is to reduce the tariffs. The US can't print money, and the Federal Reserve, they can't cut rates either. We could see another U-turn or extension of the tariff pause, and in a weird way, maybe the only way for the trade war to end is a total collapse of the US stock and bond markets. We are really deep in the twilight zone today, but let me know what you think. Will the US really call China first? Did they already give China a call? And will Bessent be desperate enough for massive bond buybacks? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.